What is stagflation? Hi there, it's Luigi, and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you enjoy watching our videos, feel free to like, subscribe, and hit that notification bell so you get updated whenever we upload a new video. In today's video, we are going to dive deeper into what stagflation really means and how it affects our economy and personal finances. So if you like these kinds of videos, then keep on watching. Stagflation is characterized by weak economic development and relatively high unemployment, or economic stagnation, along with rising prices. Stagflation is described as a period of inflation followed by a drop in the gross domestic product, or GDP. In the 1960s, during a period of economic stress in the United Kingdom, MP Ian MacLeod used the term stagflation when speaking in the House of Commons. He referred to the scenario as stagflation when referring to inflation on one hand and stagnation on the other. It was later used to characterize the 1970s recessionary era after the oil crisis, when the United States saw 5 quarters of negative GDP growth. In 1973, inflation quadrupled and reached double digits in 1974. By May 1975, unemployment had reached 9%. Stagflation resulted in the creation of the Misery Index. This index, which is the simple sum of the inflation and unemployment rates, was used to demonstrate how miserable people felt when stagflation rocked the economy. Stagflation was long thought to be impossible since the dominant economic theories in academic and policy circles built it out of their models. The Phillips curve economic theory, which emerged in the framework of Keynesian economics, depicted macroeconomic policy as a trade-off between unemployment and inflation. As a result of the Great Depression and the rise of Keynesian economics in the 20th century, economists became preoccupied with the dangers of deflation and argued that most policies aimed at lowering inflation tend to make it harder for the unemployed, while policies aimed at easing unemployment tend to raise inflation. The emergence of stagflation in the developed world in the mid-20th century demonstrated that this was not the case. As a result, stagflation is an excellent example of how real-world economic facts may often trample on commonly held economic theories and policy prescriptions. Since then, inflation has generally persisted as a general condition even during periods of weak or negative economic development. Every proclaimed recession in the United States during the last 50 years has witnessed a year-over-year rise in consumer prices. The only exception is the low point of the 2008 financial crisis, and even then, the price decrease was limited to energy costs, while overall consumer prices other than energy continued to grow. Stagflation theories. Because the historical start of stagflation coincides with the death of the leading economic theories of the period, economists have proposed a number of theories to explain how stagflation develops or how to reframe the parameters of existing theories to explain it. Oil costs. According to one idea, stagflation occurs when a rapid spike in the cost of oil decreases an economy's productive potential. The Organization of Petroleum Exporting Countries imposed an embargo on Western countries in October 1973. This led the worldwide price of oil to skyrocket, raising the cost of commodities and leading to an increase in unemployment. Producing things and delivering them to shelves got more expensive as transportation costs grew, and prices rose even as employees were laid off. Critics of this idea point out that rapid oil price shocks like that of the 1970s did not occur in conjunction with any of the subsequent times of inflation and recession. Ineffective economic policies. Another view holds that the combination of stagnation and inflation is the outcome of weak economic policy. Stagflation may be caused by harsh control of markets, products, and labor in an otherwise inflationary environment. Some blame former President Richard Nixon's actions for the 1970 recession, which may have been a forerunner to the period of stagflation. To keep costs from increasing, Nixon imposed taxes on imports and froze wages and prices for 90 days. The immediate economic shock of oil shortages and quick price increases once the limits were loosened caused economic turmoil. While attractive, this, like the prior idea, is an ad hoc explanation for the 1970s stagflation that does not explain the simultaneous rise in prices and unemployment that has preceded consecutive recessions up to the present. The gold standard. Other hypotheses suggest that monetary variables may also contribute to stagflation. Nixon abolished the remaining indirect remnants of the gold standard and brought the Bretton Woods system of international banking to an end. Since then, the United States dollar and most other international currencies have been on a fiat foundation, removing most practical limitations on monetary expansion and currency depreciation. Who gets affected when there is stagflation? Individuals who live on a fixed income, investors holding long-term bonds, variable rate mortgage holders, and credit card holders are the most badly impacted by inflation. Inflation versus stagflation. The distinctions between inflation and stagflation are minor but significant. Inflation is the gradual rise in the prices of goods and services in an economy. Low and consistent inflation has generally been associated with moderate unemployment, low interest rates, and a mixed investment climate. A period of high inflation, high unemployment, and a stagnating economy is referred to as stagflation. Historically, the investing climate has been unfavorable during stagflation, since higher input prices combined with reduced sales often translate to poorer profitability per share for firms. Are we heading toward another era of stagflation? Many economists are asking aloud whether we're on the verge of a recurrence of stagflation, which hasn't occurred in over half a century. With current high inflation and negative economic growth in the first quarter of 2022, you can see why such concerns are surfacing. Furthermore, there is worry that the economy will enter a recession. So, are we currently experiencing stagflation? Perhaps, but it is yet too early to tell. What is the cure for stagflation? Stagflation has no specific treatment. Economists agree that productivity must be enhanced to the degree that it leads to higher growth without further inflation. This would therefore allow monetary policy to be tightened to control the inflation component of stagflation. That is easier said than done, so the key to preventing stagflation is to be extremely proactive in avoiding it. Whether stagflation is occurring or not, there are things you can do to combat inflation and the challenges of an economy that is stagnating more than that old beater you drove in college. Here's a brief list of things you can do right now. 1. Don't freak out. Take a deep breath and realize that the economy merely suffers from time to time before stocking up on toilet paper or buying every bag of flour you can get your hands on. Recessions are also a natural component of the economic cycle. 2. Take baby steps. Use the risk of economic hardship to encourage you to follow the 7 baby steps with zeal. Whether you're putting money aside for an emergency fund or paying off debt, each step you take will provide you more peace of mind in the midst of a financial storm. And with interest rates rising, if you have a variable rate debt, paying it off will save you even more money. 3. Adjust your budget. You have no influence over how much it costs to fuel up your car or purchase a gallon of milk. All you can do is adjust to the realities of your circumstance. When you sit down with your spouse to discuss your budget, you may have to have some difficult talks, such as chats about cutting back on non-essentials like dining out or entertainment to compensate for growing expenses of essential budget items. 4. Look for methods to save costs. Do you have a coworker with whom you may carpool to work? Can you use generic brands for some food items? Are there any subscriptions or streaming services that you don't use that you can get rid of? It may not appear to be much, but all of those modest measures may add up to significant savings over time. 5. Invest to keep up with inflation. Inflation may affect you today, but it will really hurt you 20 or 30 years from now if you don't stay ahead of it. But how can you keep ahead of the game? By investing in mutual funds, you may help your money grow faster than the rate of inflation. There are several factors outside your control. Inflation is uncontrollable. Gas costs are uncontrollable, and you have no influence over whether or not stagflation occurs. But in the midst of all these circumstances over which you have no control, you may find serenity by taking charge of your finances. And that's it for this video. If you enjoyed it, don't forget to like, subscribe, and hit that notification bell. Thank you for tuning in to Catapult Capitalism, and we'll see you later.